Exchange traded funds, ETFs, funds, index or managed that you trade, buy or sell on the stock exchange. Okay, so you know what exchange traded funds are. They've exploded in popularity because it's an easy way to invest in the stock market, diversify and build your portfolio over time without worrying about individual stocks. But it's also become a really competitive market with more and more fund managers offering different types of ETFs. For that reason, it can be difficult to know where to start. Do you just buy a simple index ETF or do you go with something more tailored? Now, clearly there's no right or wrong answers here. It depends on what you're looking for. But since I'm a dividend investor and I particularly like income producing assets, I thought it'd be cool to share my favorite high yield dividend ETFs. These are all on the Australian Stock Exchange, and I'll also talk a bit about how I go about choosing an ETF to invest in. Also, disclaimer, I am not affiliated or sponsored with any of the companies that I mentioned in this video. These are just my opinions and not intended to be substituted for your own. Please, before you make any big financial decisions, do your own research and your own due diligence. Now that's out of the way, let's go. So just over 10% of my portfolio is exchange traded funds and the rest is individual stocks. I like ETFs because it's a simple way to diversify your portfolio really quickly. Someone else has already done the work of choosing which companies go into that fund, and generally they are less volatile than individual stocks simply because there are so many companies within that fund that it can smooth out the individual fluctuations of one company. So choosing a fund. So the first step in choosing an ETF is not only choosing the type of fund that you want, but also making sure that it's going to be sticking around for the long term. That means you want a fund that's large, liquid, and established. Sure, there are plenty of smaller ETFs out there that are probably great, but I like to stick to the large funds, and this is why. The first is fees. You don't have to pay the fee directly, it's taken out of the net assets of the fund overall. So the only upfront cost you'll have is the trading fee of when you buy and sell your fund. And of course, you'll need the money that you're investing too, obviously. So since high fees can erode some of the profits of the fund, you want to look at funds that do have lower fees. Now, most ETFs are pretty passive, which means there's not a lot of buying and selling going on. They're usually just following an index, which means the fees are usually lower, but it is something to be aware of. Now, the smaller the fund, to remain competitive and profitable, often they'll have to raise fees because they don't have a bigger pool of investors to draw from. Or in a worst case scenario, sometimes if the fund is too small and it's not profitable, the fund manager will shut it down and return that money to investors. So the larger the fund, generally the less the fees will be, and the less the profits will therefore be eroded. So what I typically look for is anything below 0.5% for a passively managed ETF. That's one that's just following an index, and anything below 1% if it's actively managed, if there's a lot of buying and selling going on. The second benefit of a larger fund is the liquidity of it. Overall, most funds tend to be less liquid than individual stocks simply because there's not as much trading going on. People don't tend to trade them frequently like they do individual stocks. People usually buy into funds because they want them to grow over the long term, which is what you should be doing with individual stocks too. So the more liquid a stock is, the more buying and selling that's going on, the easier it is to get in and out very quickly. With an illiquid stock, something that there's not a lot of buying and selling going on, it can be hard to get a really good price. So you want to keep that in mind. Third, you want a fund and fund management company that's established. Knowing that the company is reputable, has a good track record, they have experience with funds and have good fund managers means you'll just get that extra peace of mind. Because at the end of the day, the reason you're choosing a fund over an individual stock is that you want somebody else to do the work, or you want to follow an index and diversify your portfolio. So you want to be confident that they know what they're doing and they're going to get a good return for you. So here are the companies that you might want to consider. There's Vanguard, State Street, iShares by BlackRock, Russell Investments, VanEck, and Beta Shares. High yield funds. Okay, so since this video is about high yield ETFs, the next thing you want to look at is something with good distributions. Wait, what's a distribution? With funds, the dividends are actually called distributions. So because you haven't bought stock in the company directly, the fund has, you own a part of the fund and not the company's. So when it's time to pay dividends, the company will pay the fund. And then those profits, that income is then distributed to fund holders. You either get it as an income payment if that's what you've chosen, or you can choose to reinvest if you want to. Now there can be benefits to this since some companies, especially in Australia, only pay dividends twice a year and at different times to other companies. Having them all pulled together and then distributed at usually quarterly intervals means that they can be more evenly spread. I still value a high yield, especially above 5% like I do with individual stocks. This can be more tricky with ETFs, simply down to the fact that they have a larger pool of companies within that fund. And officially, high yield actually means anything above the benchmark average, which could be anything from 3% and above. But trying to hit that 5% is still something I look for. Also, if there's franking credits included, that's always a bonus. So the number of companies within the portfolio. I don't really care how many companies that a fund includes. I mean, I want it to hold at least 10, but whether it holds 50 or 1,000, I don't really care. Actually, I'd probably lean away from a fund that holds 1,000 companies. That'd be a nightmare to manage, and the fees would be super high. Plus, it'd be super diluted. You can be over diversified. So that's all the criteria I look for. Now it's time to analyze different funds. Now this is where it gets tricky because I think it's actually hard to compare funds. I think it's much easier to compare individual stocks because you have all that information in your trading program. But funds, especially in your trading program, there isn't as much information about them. Often they'll just have the price, maybe the distributions, maybe a chart. But the only way to get real information is to go to the company websites. And that can be a pain when you're trying to compare a lot at once. But since I have done that, I'm going to share with you 3 high yield ETFs that I actually quite like right now. Let's start with ETF choice number 1, the regular high yield ETF. Now, most of the bigger fund managers will have a high yield ETF. State Street, iShares, Vanguard, Russell Investments, they all have a very similar high yield ETF. Now, since there's only so many good high yield companies within Australia, most of these funds tended to have the same companies over and over. Sure, there were differences in the balance and the makeup of the shares included, but most of them followed pretty much the index, so it was really much of a muchness. So choosing here, this one was easy. It came down to size, fees, and the most prominent and obvious fund manager. Yep, this one isn't going to be a surprise. Vanguard. The Vanguard High Yield ETF, stock code VHY. I like it for a number of reasons. One, the management fee is super low at 0.25% and there's no other extra costs. It's very close to the benchmark, the number of holdings. The dividend yield is great, 5.1%, and the earnings growth, it's growing, 1.19%. There's nothing not to like here. Its top 10 holdings are what you would expect. It has all the banks and the top yielding stocks on the Australian Stock Exchange. I really like it. So now on to my next 2 picks. Now these are a little different because I didn't want to just choose another similar high yield ETF. I wanted to choose something a little bit different. There's no point in holding 2 very similar ETFs if they hold the same companies. There's just no point to double up. So the second high yield ETF is a property one. Now again, most of the fund managers had a property ETF, but here there was actually more differences between the funds, which made it a little bit more interesting. Some were more weighted towards commercial property, others were more weighted towards residential property, but most had a mix of the two. Now Vanguard's property index, VAP, was the closest to the benchmark. It has 32 holdings, pays distributions 4 times a year, and has a yield of approximately 4.2%. It also has the lowest fees. Now, it's really popular, but it's not the one I chose. To me, this fund is fine. If you hold it, you won't be disappointed. It's just kind of meh, nothing exciting. VanEck Property ETF, MVA, only has 11 holdings, but those holdings are the largest of the real estate investment trusts. It leans more towards commercial property than residential property, which I kind of like. The management fees is pretty low at 0.35%. Now, it only pays distributions twice a year, unlike the others, which is a little disappointing, but it has a yield of over 5.7%. And overall, I just like the mix of holdings in this better. So it's my number 2. Now, the third fund I chose is quite a bit different to the last 2. Now, it's also a really interesting fund. It's an active fund, which means there's a lot of buying and selling going on. So because of that, the fees are higher, but I'm just super fascinated by it. It's BetaShares Dividend Harvester ETF. So BetaShares has some really unique and interesting ETFs, and this one's really clever. So as the name suggests, they do a little bit of a dividend stripping strategy, whereby you buy before the ex-dividend date, hold to get the dividend for the required time, and then sell at a later date, and then go on to just harvest dividends from companies. I've actually used this technique in the past, but it's not something I do regularly. Anyway, this fund had a few things that I liked that got me intrigued. Well, specifically the technique, which I didn't see any of the other fund managers doing, and the fact that they paid distributions every single month. And of course, they've managed to get some really high dividend yields. Now, this does come with a bit of caution though. While you're getting great income every single month, dividend stripping or dividend harvesting can mean that you're sacrificing growth over the long term. And that is the case with this fund. So here's a chart of the return over the last 5 years. So you would not invest in this fund if you were looking for growth. Now you would still be ahead with the dividend income that you'd be getting. So you're actually ahead that way, but it is a fund for the income only. There is no growth here. So just keep that in mind. Okay, so those were my picks for high yield ETFs. So I've also put them in my preference order. If you were only looking at one, I'd probably go with the Vanguard High Yield. It's nice and simple, it's stable, and it provides a nice income and some growth. If you want 2 high yield ETFs, then consider adding a property fund to your portfolio. And third, if you're going with 3 ETFs in your portfolio, you want to try something completely different. Now, you could go with like something like the dividend harvester, where it's just income only, or you could go completely non-high yield and choose something that's more high growth, which is probably a good strategy too. But again, it depends on your goals and what you're after. Anyway, I hope you've enjoyed this video. What are your picks for a good high yield ETF? Thanks so much for watching, and I'll see you in the next video. Bye.